The Fed cut the Fed funds rate by 50 bits per second, which was in line with prevailing market expectations. The probability of such an outcome was over 67% at the beginning of the week and surprised 104 out of 113 respondents in leading financial media polls. As the sharp cut was not fully priced in, we see a strong market reaction. This change sheds light on the Fed's approach to monetary policy and could lead to a prolonged market correction, potentially changing the rules of the game for the dollar. In the official commentary, the Fed pointed to a solid pace of economic growth, slowing employment growth and declining but still elevated inflation. The Fed expressed confidence that inflation would move towards its 2% target and, on that basis, moved swiftly to normalize monetary policy. Estimates for the Personal Consumption Price Index were lowered from 2.6% to 2.3% for 2024 and from 2.3% to 2.1% for 2025, against a long-term target of 2.0%. The forecast for the unemployment rate was raised from 4.0% to 4.4% for the current year and from 4.2% to 4.4% for 2025. In the new projections, the FOMC members identify 2.9% as the long-term neutral interest rate level. It was 2.8% in June, where they intend to take the rate in 2026 to 4.4% by the end of 2024. It was 5.1% in June and to 3.4% by the end of 2025. It was 4.1%. One can see how much more dovish the Fed's stance has become in just 3 months. This is most likely the result of a massive downward revision of job growth estimates for last year by over 800,000. What is important to understand now is whether the Fed's extreme softness will be an excuse for central banks around the world to follow suit at the same pace. The ECB's Centeno, for example, had already warned on Thursday that the bank could accelerate the pace of policy easing. However, the Bank of England has yet to do so, leaving the base rate at 5.0% after cutting it in early August.